Hello everyone, welcome back. Welcome to July of 2013. My name is Ed Ponsi from edponsi.com. It's good to see you again. Here we go. It's almost the 4th of July. Fireworks already, right? With the markets going wild. Okay, I told you last week that I didn't think Bernanke was going to wreck the market. Okay, Bernanke wrecked the market. My bad. But the FOMC members ever since then have been backpedaling. Pretty much every FOMC president or every Fed president from Dallas to Minneapolis to Chicago to New York and everywhere in between are all saying, hey, the market's overreacting to Bernanke and the stocks are going back up again. That's a beautiful thing, especially if you own the right stocks. Last week we talked about buying chips on the dip, and some of those chips have done very well. Marvel Technologies has been a great winner, right? We've had a lot of good stocks lately by buying the right stocks and shorting the right stocks too. We've been buying stocks like Starbucks and selling stocks like Colgate-Palmolive. It's been a beautiful trade. It's still working for us, right? Now, when I look at the markets now and I'm looking at the charts, the interesting thing that's happening is this. We've had a change in the yield curve. You may have noticed that mortgage rates have gone up quite a bit, for example. Right? That's because the long end of the yield curve, longer-term bonds, are now higher yielding than they were just a month ago. Now, how do we make money from this? Who's going to profit? Generally speaking, banks borrow at the short end of the yield curve and lend out at the long end of the yield curve. So the steeper it gets, the more money banks can make. But not all banks are going to benefit equally, and that's the key that I'm going to teach you about today. Not only are we going to talk a little bit about the yield curve, but understand this, right? The really big banks, the Citigroups, the Bank of Americas, JP Morgans, they are not going to benefit as much. Why not? Because they're not, generally speaking, lending isn't their main business. Those are investment bankers. Those are global banks, right? They've got their hands in everything. No, the real beneficiaries here are going to be the banks that have a tendency to write mortgages, and those are the regional banks. Writing mortgages is a bigger part of their business. It's much more important to them. So the regional banks are the ones that you want to look at. Out of the bigger banks, maybe the most interesting one is Wells Fargo. As far as ETFs are concerned, I like KRE, the regional banks. And that's something that I definitely want you to look into. You can go in there, look at the charts of the different components within there, and pick some winners out of there. But there's a lot of good stocks in there. And the regional banks on the charts, they're blowing the too big to fail banks away. So it's kind of a no-brainer right now. That's where you want to go. You want to go with the regionals over the too big to fail names, the Citigroups, the Bank of Americas, etc. Okay, stock people. What about my Forex people? All right, my currency peeps, listen up. Okay, here's what's going on. By the way, I'm going to be on CNBC in about an hour and a half from now, so I got to get this done. Let's finish it up. All right, Australian dollar. We have a big election coming up. There's a lot of political turmoil in Australia. The numbers are really bad out of China, and the commodities prices are just dropping like stones, and this is really bad for Australian dollar. But it is hanging in there, but I'll tell you what, for one thing, people are asking me, should I buy it? If you buy Australian dollar, you're buying into something that's very dangerous to own right now. If you short it, you're shorting something that's already being heavily shorted. Okay, if you look at the commitment of traders reports, right, on the CME, you've got a 4-to-1 ratio of shorts to longs on the Australian dollar. It's a very dangerous trade either way right now. I prefer right now the dollar yen. Let me tell you something. Dollar yen, I think, is going to go back up above 100 very soon. Here's why. The Japanese stock market appears to have formed a double bottom, the Nikkei 225. The stock market in Japan and the dollar yen currency pair have a tendency to run together. So if I think the Japanese stock market is getting ready to rally, a good way to play that might be through shorting the Japanese yen, buying the US dollar against it. That could be another play of the day. And the other one I want to talk to you about is the euro. We're definitely seeing improvement on the manufacturing PMIs out of Europe. Good numbers on Monday. Okay, so on Monday, July 1st, good numbers out of Europe for the most part. Much better than what we're seeing in China, for example. Okay, so Europe looks like it's on the road to recovery. I do think euro can pop back up to 132 in the short run. Be very, very careful. All of you people, stock, currency, whatever you're trading, hold the phone, right? Because Thursday, the 4th of July, is a holiday. The 5th of July, the markets are open, some of them, but it's going to be very thin and illiquid, and you're going to get non-farm payroll. So things are going to get crazy in the morning on the 5th because there are going to be very few people involved and potentially big market moving news. So things could get pretty wild. So be super careful on July 5th, or if you have positions laying around out there, be sure to keep close tabs on them, okay? Don't just forget about them over the 4th of July weekend for all my friends in the U.S., because it's not a holiday in Europe, it's not a holiday in Asia, it's not a holiday anywhere except in the U.S. So keep that in mind, my American friends. Everybody have a great day. Thank you for listening.